Hey everybody, welcome to Money's No Object. I'm your host, Dylan Howell. This is episode number 67 of our YouTube channel and podcast, and I could not be more excited to continue sharing with you guys personal finance topics that I think can be really useful for you in your long-term financial freedom journey. Today, ladies and gentlemen, is election day. If you haven't voted, go vote. If you have voted, good job. But today is election day, and the concern for a lot of individuals around today and leading up to today, as we've seen a lot of volatility in this past week, is that the stock market is going to suffer because of certain political ideologies of one candidate or another, or one side or the other. And I want to help you today to take a look at what market crashes really look like, because I want you to be prepared. I want you to understand what market crashes look like. And then I want you to have a positive outlook when it comes to market crashes and what they mean, even though obviously they don't happen in the best of times. I want to help to set aside this fear of a crash on a particular day when a lot of individuals are calling for one for some particular reason. So I want to help you guys to have a long-term view and a view of stock market crashes as opportunities and not as these terrible things that you need to sell. Before we get started though, if you could go down below, hit the big red subscribe button, like this video, leave me any feedback in the comments. If you're listening on Apple or Spotify podcasts, then subscribe there and leave me a review. Follow me on social media at MNO with Dylan. And then if you want to work one-on-one in financial coaching, you can go to my website, www.mnowithdylan.com, and you can click on the Work with Dylan tab and pick the financial coaching session type that would work best for you, and we can begin to work together one-on-one. So first of all, let's talk about what constitutes a market crash. What is that? What does that even mean? What is that vernacular even used for? Why do we call it a crash? What does it look like? Well, market crashes are typically these rapid and unexpected drops in stock prices. Crashes happen fast. Crashes happen with a lot of intensity. And so that's what a crash is going to look like. And these crashes can be caused by some major catastrophic event, some type of bubble that has burst, some speculative bubble. It can be due to some type of economic issue, some systematic issue that the market just reacts to all at once. I mean, we've seen it this year. When you talk about a major catastrophic event, COVID-19 gets about as major and catastrophic as we have seen, because it shut the economy down. It didn't just slow it, it shut it down for a particular amount of time. And what this did was this sent stocks into free fall in March, and late February, early March, it sent stocks into free fall. And then I think the fact that we've actually seen it this year leads people to think that, oh, an election's coming, it's going to happen again. And we have this recency bias to where we say, oh, we've seen it before, we're going to see it again. And I don't think that should necessarily be the case. And if we look historically, it's probably not the case. But we have to understand that even if it does happen, we have to be prepared mentally. We have to be prepared emotionally. We have to be prepared and understand what crashes look like and how we should respond to them. And to be honest, most crashes gain steam because of panic. It's herd mentality. It's herd behavior, to where one investment bank or one financial institution sells a lot of stock all at once. And so everybody's following the money, and they continue to follow the money, and other people follow those people, and it compounds downward at such a fast and just out of control rate. And that's where most crashes come from. They come from this one contributing, market member, or a few contributing market members making big sales, and these, getting rid of these big positions, and then people follow those positions and follow it down and down and down and down. And that can lead to some short-term hurt and these big crashes of the market. To put it simply, overreactions are what happens in market crashes. You can bet in every crash that you can see, if you look at the S&P 500 chart over time and you look at the crashes, 1987, 2000 through 2002, you look at 2008, 2009, you look at this year, there has been an overreaction every single time. It has dropped more than it should have every single time because of this panic, because of this herding of investors to all say sell all at the same time. And the truth is, there's no specific threshold at which we can say, oh, that was a crash or that was a crash. But it's typically considered to be when there are abrupt double-digit percentage losses in the market. So we see what a market crash is. We kind of see what it looks like. What have been the previous ones? What have these market crashes of old looked like? And then how is that going to inform us moving forward? So the first one we're going to look at is the stock market crash of 1929. Basically the beginning of the Great Depression. This was the crash. The stock market crash of 1929 began on Thursday, October 24th, 1929, when panicked investors sent the Dow Jones plunging down 11% in heavy trading. That's a big drop in a single day. And the 1929 crash was preceded by a decade of huge economic growth and large run-ups in stock prices, specifically those of the Dow Jones. For instance, over the preceding 5 years, the Dow Jones had risen over 400%. That is a huge gain over a 5-year period and shows you that there was probably a lot of speculation. There was probably a bubble to be popped, and the bubble did pop. Some other factors that led up to the 1929 stock market crash were things like these actions by public utility companies that weren't necessarily the best, the overproduction of durable goods, and then an ongoing agricultural slump. All of these things persisted into a stock market crash. And between October of 29 and July of 1932, the market fell 89%. Now that 89% is not the crash itself. The crash would have been that short-term couple of days where the market just fell hard, and that 11% day that the market just fell hard, that is the crash, but it continued to precipitate downward throughout the depression. And that can happen. It has happened before. And so what can we learn from this? What we can learn from this is that the market can fall very fast and the market can fall for a long period of time. But think about if individuals were actually buying through the depression, if they could, if they had the residual income to do so. They were buying at such low and depressed prices that over time they would have made a ton of money. And let's not even look at that. Let's just say, we see that this was a huge economic event. It was the Great Depression. And this economic event did subside. It did go away over time. And when it went away, the market came back, and it came back with a vengeance. And so this is something we can learn from, in that big economic events happen. We've seen it this year as well, and we'll get to the COVID-19 panic. The market panics happen, the economic events happen, and it's just all about how you react to those events. And obviously, a lot of individuals don't react favorably. And then some people can't react favorably. Some people during the Great Depression likely had to sell their stocks just so they could take care of their family, and just so they could eat, and just so they could do basic things. And that's completely understandable as well. But if you have any type of excess that you can put to work during crashes, that's always a good idea. And then another big drop came almost 60 years after the drop of 1929, and it was Black Monday in 1987. And so to this day, Black Monday is the largest one-day drop in the S&P 500 that has ever been recorded. And this, again, was October. It was October 19th of 1987. The Dow Jones lost almost 22% in a single day. That is a huge decline in prices. And that triggered a global stock market decline. Like I said, selling upon selling upon selling, and it just precipitated downward. And what's funny about this one, this didn't have as much economic issues behind it. It had a lot more to do with geopolitical issues that were going on at the time, and the fact that there was electronic trading that was just kind of coming into its own, and this algorithmic trading that we know so well now was just beginning. And when individuals were selling, it was hitting these triggers on these algorithmic trades, and it was just continuing to sell and sell and sell and continue downward the drop of the market. And so this one didn't have anything huge economic behind it. And so we have to understand that as well, that there are big drops in the market that don't happen because of things that we can easily see. Yeah, there may have been some basis for the market to drop, but was there a basis for the market to drop 22% in a day? I think not. Once again, overreactions, and we should take advantage of overreactions by buying stocks. And then what about the 2001 dot-com bubble? Some of us remember this, some of us don't. But the dot-com bubble was basically the fact that in the 90s, these internet companies were coming out of nowhere. And a lot of them got really high market valuations because the market was just like, anything internet, we're just going to throw money at, and it's going to work. It's going to work. It's going to work. Well, a lot of these companies never even made it profitable. And so they failed on a large scale. And when they failed, the market dropped hard. And so this, again, didn't have as much to do with something that was just economic. It didn't have to do with a recessionary or depression situation, although there was a recession. But recessions occur from time to time. They happen. And so it wasn't necessarily an economic issue as much as it was that there was this speculative bubble. There was this thing to where people had just been throwing money at something that there was no value in. And over time, what will happen if people continue to throw money at something where there is no value? That bubble will pop and prices will drop. And so that's exactly what we saw happen with the 2001 dot-com bubble. And this crash was so bad that the NASDAQ, which covers most technology firms and smaller firms, so it held a lot of these companies that ended up going bankrupt. The NASDAQ fell from March 10th, 2000 to October 4th of 2002 by almost 77%. That is huge. Once again, obviously, that is not the crash, but that is just the continuation of the negativity and the continuation of companies filing for bankruptcy and companies going out of business. And you saw that play itself out in the NASDAQ. And once again, you see these speculative bubbles, you see things that are far overpriced. And you've seen, even going back to the Great Depression numbers, what was the thing? It was far overpriced already. The market had run up 400% in 5 years. What about 1987? Well, there had to be some type of correction. We don't necessarily know that there was a huge run up to that point, but obviously stocks were doing quite well. But then, 2001, we're looking, that is a definite speculative issue. That it got to a point that was out of hand and it had to be brought back down to earth. And typically when things are brought back down to earth, they aren't just brought back down to earth, they're brought through earth, right? So where you think stocks should be, it's typically brought through that point. Once again, overreactions on the downside because of herd mentality. Once again, we see that, and we see that this occurs. Again, the market has since bounced back from 2001. Now the NASDAQ, it took a long time to recover all its losses because losing almost 77% of value takes a lot of returns to get back, but it has definitely done so as well. And then let's get to the ones that we remember and that we kind of hold right there in our minds and that we're afraid that they're going to happen again. 2008 financial crisis. This was a mortgage crisis, a credit crisis, and it was all triggered by the fact that in the years leading up to 2008, there were a lot of loans given on homes to individuals who should not have been getting loans on those homes. They did not have the credit standards or the income standards that they needed to purchase homes. But there was all this subprime mortgage underwriting going on to where they were giving these loans to people who probably didn't need to have them in the first place. And these individuals couldn't pay their bills. And this ended up making its way through the economy in the way of mortgage bonds, in the way of collateralized debt obligations and collateralized mortgage obligations, which we're not going to get into, but that's kind of how it moved through the economy. But again, what ended up happening was there was a speculative bubble. It was a housing bubble. And how does this bubble occur? Just as any bubble occurs, there's a lot of buying and optimism, and everybody's buying and they think things will always go up. And things do not always go up. And so then things have to be brought down through earth. Like I said a moment ago, they have to be brought down hard in order to correct them. And that's exactly what happened. We went into a huge recession due to that fact, because it was really the first time we had ever seen mortgages being defaulted on at the rates that we saw. In the fall of 2008 alone, the stock market dropped over 30%. This is huge. This is a huge drop. This is, especially if it's done just maybe in a quarter of time, that is a huge drop in the market. And it had an effect on a lot of people. It affected a lot of people's retirement accounts. It affected a lot of people's lives. But if you could stick it out, you'd be far ahead by now, because now we're sitting at a point where the market is near all-time highs. I think we're about 9% off. The market has dropped a little bit over the past few weeks from the highs, but we're still far ahead of where we were 12 years ago in 2008. And the market bottomed in March of 2009. So a little over 11 years since then. And we have, far since recovered. So like I said, over time, stock prices are going up. But these speculative bubbles, these issues in the economy, these big catastrophic events can get in the way, and they can cause stock market crashes. And so we get to the catastrophic event here. The catastrophic event was what? Was COVID-19. It was coronavirus. And what happened? Well, the president was forced to shut the economy down for a period of time, and the economy still hasn't gotten back up to 100% capacity at this point, but was forced to basically completely shut it down at one point, other than people who could work from home and do things like that. Everybody was in home and not necessarily able to do the work that they could do, and small businesses were suffering and still suffer today. But it's a catastrophic event. Something happened that was outside of the purview of what we thought could actually occur. And what happens in that case, when the economy gets shut down, there's no certainty of when it will open back up, or no certainty of how companies will make profit moving forward, or no certainty of whether companies will even exist moving forward, the stock market drops hard. And so what did we see? We saw the stock market drop over 30% in a very, very, very short amount of time. If you go look at the S&P 500 chart during that time, it fell hard and it fell fast. And I've told you before, I bought in the bottom. After the market had dropped over 30%, I was purchasing stock. I was purchasing shares of things that I knew were going to go up in value over time. And why? Because you can find opportunity in crashes. But we've seen in each of these issues, right? There are economic issues that occur. We get that. There are speculative bubbles that occur. We get that too. And there are major catastrophic events that occur. Now you have to understand, this is not going to stop over time. There will always be economic issues that occur. There will always be speculative bubbles because people get too optimistic about things and they just want to buy it all up and everything's going to be good forever, and they're wrong. And then there are catastrophic events that we couldn't see coming that will occur. It may be a long time between catastrophic events, but they still occur. So then naturally we come to, should you worry about stock market crashes? Well, first off, we always bounce back. And I know that's not a great argument, but we do. We have always bounced back. Historically, we have bounced back from crashes. And that's a good thing to know. The American economy is resilient and has been resilient many, many times. The stock market has never gone to zero because, like I said in yesterday's video, do you expect that all companies that are large and profitable and do all the things that they do that are so integral to our lives are just going to go bankrupt all at once? No. So the stock market doesn't go to zero. And then if you just looked at the S&P 500 chart, if you just looked at the price of the S&P 500 over time, it looks like this. It looks exponential. It's an exponential curve that goes up. It goes up, it goes up, it goes up over time. You draw a trend line through it, the crashes go away. Because like I said, the crashes are overreactions to speculation or economic events or catastrophic. And that's not to say those things aren't real and that those things didn't need some type of response by the markets, because they definitely do, because there's a reason why the prices fell. But there are overreactions. It's not just a reaction, it is an overreaction. And then let's not forget that in the indexes, when certain companies fall by the wayside or go bankrupt, they are replaced by other companies that are of value and that are meeting the criterion of the indexes. And so that does happen, and it allows the indexes to grow forward over time. And then let's not forget that our game is not the short term. Our game is long-term investing. Our game is investing for the long term. I've told you before, if you can't invest for over 5 years, you shouldn't be investing because the likelihood of the stock market dropping and staying down over a 5-year period is greater than any time period longer than that. So if you can't invest for at least 5 years, then you probably don't need to be putting that money in the market itself. So if long-term investing is the game, then we don't care about short-term crashes. We don't care about the market dropping hard over a few days or a few weeks or a few months, whatever it may be. We don't care as much about that. Yeah, does it stink to see your account values drop and drop and drop? Sure, but guess what you're doing that whole time, or should be doing that whole time, is buying, consistently buying, putting money in your 401k, putting money in your IRAs, doing all of those things that you're supposed to be doing systematically as a part of the financial action plan. You should be doing those, and they will be profitable to you over time because you are buying at cheaper prices. Therefore, you will make better returns in the long term. You're not just losing all of this money, you're actually putting more money to work. And then you can make the decision as well to put more money to work on your own, as I was talking about earlier. And let's not forget that you don't actually lose money until you sell. I mean, everything else is just based on market value of stocks and market value of indexes over time. But until you actually sell, you didn't lose anything. You didn't realize any loss. And so if you sell, then it gets real. But if you hold on over time, you ride the roller coaster over time, then you will be fine. Things will turn out well. They have historically turned out well. And the truth of the matter is you just don't know who you are as an investor until a crash. For instance, the coronavirus pandemic was the first crash that I have dealt with as an investor. I was alive for a couple of the other ones, but I didn't have money in the market at those times. I was a child, and so I didn't have money in the markets. But now that I do, and I see the crash happen, there's 3 things that you can do. And I saw people do all 3. And one of them is completely wrong, and the other 2 should be where you lean heavily. And so you can really do 3 things in a crash. You can either sell, which is wrong. You should not be selling during a crash unless you absolutely have to maintain and pay your bills and live your life because you lost a job or any number of bad things that happen economically because you're seeing the crash. The crash is for some reason, and it may be an economic one that got a hold of you and your household. So that's the only time you should. Otherwise, you shouldn't be selling your investments. Then the other one is you should hold them and ride it out. And this is a perfectly fine thing to do, especially with individuals who aren't super sold on the market already and don't understand and do the research as much. Sitting and holding is perfectly fine. Perfectly fine. Just ride it out, allow yourself to do so. And then there's individuals who buy. And to be honest, if you're putting money into an employer plan, you are buying, but you're not making the natural decision to go buy more. Because you can make that decision to do that. And so those are the only 3 things you can do, but you have to at least be holding on and riding it out. And hopefully you invest more. You have the wherewithal to do so. And then these crashes, they just let you know if you can actually put your money where your mouth is when it comes to your long-term viewpoint. Because if you say you're a long-term investor, a crash will reveal that. A crash will reveal if you really are a long-term buy and hold type investor or if you just want to make a quick buck. Because if you want to make a quick buck, the stock market's not a great place to be if you are trying to be a long-term investor. Long-term investing happens over the long term. You compound your money over time. You may make short-term profits that are very nice, but you're not selling them. You just continue to buy and buy systematically over time. And the sad part is a lot of people miss out on returns by either selling or failing to get back in at any particular time because they're trying to time things. They're trying to get out at a perfect time and get in at a perfect time. And let me tell you, I don't know if I've ever seen somebody do it correctly. And if they have done it correctly, then bravo, that's awesome. But to see an individual do it correctly, most times it's individuals will do it and they will sell when it's low and end up getting back in when it's high. And that's the total opposite of what you want to do. You want to be buying low and selling high, not buying high and selling low. And then just remember that crashes give you opportunities. They give you opportunities to put more money to work. They give you opportunities to keep a level head, prove that you're a long-term investor, and put money in at low prices and get deals that other people can't get. It's funny that if we'll go to a store and see a shirt that we like that's 25% off and we have to buy it. Well, why don't we look at stocks the same way? Why don't we look at indexes the same way? If they're 25% off of what they were worth previously or 30% off what they were worth previously, then why shouldn't I buy it? Isn't it, aren't they still the same companies? Isn't it still the same economy? And so you can look at the stock market crashes as opportunities, and you can allow them to just not scare you, not push you off of your investing principles and what you believe to be true about investing over time. So listen, today or tomorrow or within the next week or however long, sometime within that time period, we are going to find out who the president will be for the next 4 years. And that might send some people into a panic, and that might send some people into a frenzy, and that might make people lose their heads and do things that are not becoming of a long-term investor. But that shouldn't be you. Don't let the short term tear down what you believe about investing and what you have seen over the long term about investing and what you have learned about investing by listening to me, listening to other individuals, reading, looking at the charts yourself, looking at the prices yourself, looking at the returns yourself, and understanding exactly what's going on. I'm not saying that regardless of who the president is, returns are going to be fantastic. We don't know that. But I can tell you this. I can tell you if you go and look at Democrat versus Republican, or you look at the last 7-8 presidents that we've had, it doesn't matter. Democrat or Republican doesn't matter when it comes to returns. When the president came into office didn't really matter when it came to returns. The stock market has gone up over time, and it didn't really care. Yeah, were some presidents more business friendly than others? Sure, but that didn't impact long-term returns. The long-term returns that I've told you, like in yesterday's video, they included all of these past presidents. And even though you think, oh, well, this time is different, let me tell you, history doesn't necessarily repeat itself, but it definitely rhymes, okay? So if you can look at history and you can say, I've seen this before, I have seen what happens before, I've seen how investors react before, and you can make your decisions based on that. That's probably your safest bet moving forward. But just always be buying. Don't let crashes freak you out. Take them as opportunities every chance you can, and do not be selling a crash unless you don't have a choice. So hey, don't forget to subscribe to this channel. Also like this video. Leave me any feedback in the comments if you haven't already. If you're listening on Apple or Spotify podcasts, subscribe there and leave me a review. Follow me on social media at MNO with Dylan. And then also check out my website, www.mnowithdylan.com, if you're looking for financial coaching help. And you can click on the Work with Dylan tab and pick the financial coaching session type that would work best for you. And we can begin to work together one-on-one on how to get your financial life in order and how to push forward toward financial freedom over the long term. So tune in tomorrow as I talk about why individual stocks are not necessarily for everyone. So hey, thank you guys for tuning in to today's episode of Money's No Object. I'm your host, Dylan Howell. God bless.